Hello everyone, I'm Dan Veru, Chief Investment Officer and Co-Chairman of Palisade Capital Management. In the next few minutes, I would like to share my thoughts on the recent outperformance and future prospects for the Russell 2000, which I have called the reopening of the economy benchmark. The election is over and we have a new incoming president and vice president. We've had announcements on two major scientific breakthroughs in the battle to combat the COVID-19 virus, which have the potential to put the country on a path to full reopening. Since the election on November 3rd through November 20th, stocks have responded positively, with the S&P 500 appreciating about 5%, while the Russell 2000 is up almost twice that amount at about 10.5%. In previous notes and interviews, I laid out three scenarios for the outcome of the election: a Biden presidency with a split Congress, a Trump presidency with a split Congress, and a blue wave Democratic sweep of the presidency and the Congress. Joe Biden and Kamala Harris will take office on January 20th, 2021, with a near-even split in Congress. The plans for the Biden-Harris administration had included big spending on infrastructure, green economy initiatives, and further expansion of health care. Offsetting the economic tailwind of these policies were less business-friendly plans to raise corporate and individual taxes and for new regulations on the oil and gas and banking industries. The split in Congress will almost certainly curb the administration's ambitious plans, especially the unpopular tax increases and an increase in regulation. These are likely to be scaled back or eliminated entirely. Even with two undecided Senate races in Georgia, Democrats would have to win both seats just to have a 50-50 Senate split, which would still curtail many of these ambitious plans. If Senate Republicans remain in the majority, it will be the first time an incoming Democratic president did not have the Senate since the 1880s. The House of Representatives will remain with the Democrats, but with the smallest majority since FDR was president during the passage of the New Deal. Voters seem to prefer the policies of the current president, which are more likely to stay in place, while voting the man out of office. While policy initiatives of the new administration may have to be modified, trade tariffs, which do not need congressional approval, will likely be reduced or eliminated. More economically impactful for the U.S. are the historic scientific breakthroughs for vaccines to combat the COVID-19 virus. On November 9th, Pfizer announced the results of a clinical trial with over 90% success. Then on November 16th, Moderna announced a vaccine with 94% efficacy, delivered in record time for a vaccine. Both should receive approval and be available for the at-risk population before year-end, and more broadly in 2021. These breakthroughs increase the likelihood that our economy can potentially return to normal by mid-year 2021. The election and scientific breakthroughs for COVID-19 have been a tailwind for stocks, but the Russell 2000 has been particularly strong, not only in the strong advance of the benchmark, but also in its incredible breadth. I started observing the outperformance and breadth blowout days occurring in early summer, but back then it was typically tied to some medical advancement or improving prospects for the economy to reopen. Since late August, the relative outperformance of the Russell versus the S&P 500 is happening more often, and the benchmark has outperformed and is within 500 basis points of catching the S&P 500. Despite a sharp rise in nationwide COVID cases more recently and the negative economic ramifications of that. I believe that the stock market is predicting the full reopening of the U.S. economy in 6 to 8 months, with the Russell 2000 positioned to be the biggest beneficiary for the balance of this year and well into next year for the following reasons. First, the Russell has underperformed other large-cap benchmarks since the third quarter of 2018 and has only recently made a new high. By contrast, the S&P made its previous high in late February of 2020 before making a recent new high. Perhaps the best example of the underperformance of the Russell versus the S&P is to look at Apple. This past August, Apple had a larger market cap at $2 trillion than the total market value of the Russell Index at $1.9 trillion. The Russell 2000 is more attractively valued and correlated to the U.S. economy at a time when the U.S. economy could normalize by mid-2021 as a result of broadly available vaccines. The Russell is much more of a U.S.-centric benchmark compared to the S&P 500, which has about 40% exposure to non-U.S. demand. My final thought is relating to fiscal and monetary policy tailwinds. On top of broadly available vaccines, these tailwinds could cause a steepening of the yield curve and higher interest rates, and perhaps the prospect of higher inflation. Small cap stocks tend to be the single best equity benchmark in times of higher inflation. Banks, industrials, and materials stocks, which account for more than a third of the benchmark, could see dramatically improving business prospects under that scenario. Though the recent rise in infections is troubling and could still potentially have a negative impact on the economy and stocks, we're only weeks away from the start of the availability of 2 vaccines, with more to follow, which should allow for the U.S. economy to have a sustainable rebound. As a result, the stage is set for 2021 to be a turning point for the Russell 2000, which has lagged for more than 2 years relative to other equity benchmarks, and it's positioned well to lead all domestic equity benchmarks. On behalf of everyone at Palisade, I hope you all have a happy and safe Thanksgiving. Thank you.
The information contained in this webcast reflects the views of Palisade Capital Management, LLC, as of the date of its original broadcast, and such views are subject to change without notice at any time. All information provided in this webcast is for informational purposes only and should not be considered investment advice or recommendation to purchase or sell any specific security. While the information presented herein, including information obtained from third parties, is believed to be reliable, no warranty is made concerning the accuracy of such information. There can be no guarantee that any forecast discussed in this webcast will be realized. Consult your financial advisor before making any financial planning or investment decisions. Past performance is not a guarantee of future results.